Hi, I'm RJ Baxter of Fairway Independent Mortgage with your weekly market update. I hope you guys are having an awesome week, and I appreciate you watching the video today. I have some very, very important news to share today, and that is that rates have gone up over the past week. So if you're out there looking to buy a home, if you're searching for a home, or if you're looking to refinance, this is definitely something to key in on. And I just wanted to get into a little bit of technical stuff and show you guys what's happening. And I'm going to explain it really on the surface. You don't have to understand the nuts and bolts of what I'm showing you here. But what I have in front of me here is a chart that we follow on a daily basis. And what this is charting is what are called mortgage-backed securities. These are the bonds that back mortgages. And this is the 30-year bond. We follow this every day, and we have a service that we subscribe to that advises us if people should lock their interest rate or they should float, which means to not lock and wait and see what the market does. And I wanted to show you this general trend. So basically, to explain it in really basic terms, green is good for rates, better rates, and red is bad for rates. And you'll see here over the course of the past month or so, we had a sharp downturn at the beginning of January, and then it kind of rebounded a little bit, and then a little bit of a downturn here. But then over the past week, we've had these huge drops in bonds. And this is bad for rates. So what we've seen is compared to this time last week, rates are anywhere from 1/8% to 1/4% higher. So definitely something to key in on if you're out there looking. And just to translate that into dollars, if you're taking out a mortgage for $400,000, just as an example, 1/8% on the rate translates to $27 per month on the payment. So it's not, not the end of the world, but certainly something to be aware of. Now, will rates bounce back? That's the big question. You'll see here we have a couple green, what we call candles here, green bars, which is a good sign, but the markets are having a hard time breaking above this red line here. So we'll see how it plays out. I mean, my humble opinion is that the Fed is not going to let rates get out of hand at this point. They're in there buying these mortgage bonds to help keep rates low, to help to keep the housing market stimulated. So my opinion is that they're going to continue to do that to the level that they need to keep rates down. It's hard to say if rates will continue to where they were over the past 12 months, because if you extend this chart out to 1 year, you see here, we're back to where we were midsummer. So rates are the highest we've seen since last summer. Certainly not high rates by any means, but again, just something to key in on. And here's one other thing I wanted to show you guys is the forecast on interest rates from two different sources. This is for January. The first is the Mortgage Bankers Association. And you'll see here that they're expecting rates to go up to the mid threes by the end of the year, and then up to near 4% by the end of 2022. But if you look at the Fannie Mae housing forecast, they're only predicting 2.8% at the end of this year, and then 3% at the end of next year. My opinion, I wouldn't be surprised if it's somewhere in between low threes, something like that by the end of next year. But certainly low enough rates to make buying a home make a lot of sense, to make affordability still be there, and to make refinancing in a lot of cases make sense. So give me a call if you have any questions about this. I know it's a lot of technical stuff this week, but I just thought I'd show you the charts that we look at on a daily basis, because it really illustrates what's going on here with this slight jump in rates. So you guys have a great rest of your day. Appreciate you watching. Once again, my name is RJ Baxter, Fairway Independent Mortgage. Thanks a lot.